Permanent pothole fund and tampon tax notwithstanding, global markets are proving wholly indifferent to the UK's new spending plans. Even the revelation that the government will need to borrow £4.5 billion more than projected failed to drag investors away from their obsessive scrutiny of European and US central banks and their Thanksgiving dinner plans. Prices for gilts are drifting along, pulled to and fro by the possibility of a rate rise in the US and a rate cut in Europe, with little room for reflection on the country's own circumstances. Gilt yields have edged down by 7 basis points this month, matching the 6 basis point drop in equivalent German bunds. But contained within this week's autumn statement is something that does have the potential to shake up the UK's debt market. The government's insistence on devolution of power means plans to give councils more responsibility for funding local services, and that could prove the catalyst needed to finally kickstart a municipal bond market in the UK. Elsewhere in the world, local bonds are already a mainstay. The US has a $3.7 trillion market, popular thanks to its tax exemptions, while in Europe, cities including Paris and Madrid are regular bond issuers. In the UK, however, local government debt issuance has withered since the 1980s, replaced by cheap central government loans. Now it's back, following the creation of a new company, Local Capital Finance, which will sell bonds and use the proceeds to fund local authorities. That's the theory, anyway. In reality, the first bond was expected to be issued in April, but as the end of the year approaches, there is still no sign of it. The sticking point is likely to be the price and the difference that investors will charge to lend to local rather than central government. Take India, where the country's 29 states are slowly opening up their local bond markets to international investors. There, the difference between the rate at which states can borrow and that of the Indian government is stark. Although the Indian central bank says that all states receive sovereign guarantees, investors will charge India 7.72% to borrow for 10 years, while a state like Gujarat is charged 8.15%. Add to that the premium that will be charged to a new issuer and the lack of liquidity that is likely to greet the first issuance of a new market for local authority bonds, and it's easy to see why borrowers might need convincing. But regardless of the difficulties, the changes announced this week in the spending plan mean that a UK Muni market is still on the cards. We'll just have to be patient.